I jumped ahead. Here we go. So investor questions. This is a very dense slide. There's a lot that you should be prepared to sort of field from a pitching perspective when you're pitching to a potential investor. Not all of this has to be in your deck. I often encourage decks to be a little bit more simplified. Like you don't want to go into a pitch session with a potential, like a first-time investor with a 30 or 40 page deck that you plan to walk through that has detailed breakdowns of all of these different elements. You want a more concise 15 page, 10, 15, maybe 20 tops page deck that you can get through in 20 to 30 minutes, accelerated time, pitch time, and then maybe have appendices that you can speak to various questions from the investor. But it's very important to have that seamless walk through sort of problem, solution, why you're the right team, and exit strategy and financials. But you should be prepared to answer all these different questions. So on market and solution, you want to know what your total addressable market, your serviceable addressable market, and then serviceable obtainable market are. Of course, what problem you're solving for, and what's your solutions. That's pretty standard. Scalability and growth strategy. So I've seen some funds pitch that don't really have that many financials in their pitch deck, and that's okay, knowing that if you're pre-seed and seed stage companies, because every single financial model is just an estimate and a projection. They never come true, right? It's just sort of, you're shooting from the hip, especially if at the seed stage. This is your best guess estimate. But an investor wants to know at least what your 1 and 3 year plans are. If you're raising a Series A and beyond, 5, then maybe 10-year plan. Early stage, you need to at least have 1, preferably 3 year projections out. And the numbers don't have to be perfect, but you just need to be able to justify what your inputs are. Like, why are you assuming this cost of your product now, and then this cost of your product in 3 years? An investor just wants to know that you've done the work and you have a defensible answer there. From a growth perspective, what new markets are you hoping to hit as well? So one thing we always encourage our portfolio companies and make sure that they're laser focused on, do the 1 or 2 things that you're set out in the market to do, and do it really well and do it better than anybody else. I shouldn't say a lot, but some investors will get into a pitch call and they talk about what their beachhead market is and their go-to-market solution. And then for 10 minutes at the end, they talk about all the research and development that they're doing. And they could go into this market, and there's this application and this and this and this. And we could do this if you think there's a market there. That's all fantastic. And like, the R&D portion is important, but it shouldn't be your primary focus. And you really need to focus on doing 1 or 2 things really well, getting that right. And then you can branch off into other industries. The investor wants to know that you are steering the ship and like what your pathway to market is. Not the worst thing, but one thing I suggest that people don't do is, I've had a couple times founders ask me about, like, well, these are the different markets we could play in. Like, what do you think would be a good fit for our technology? Or do you think like this could be a good application? We really want to know that you've done the work, especially from a market research perspective, and know the technology inside out, and say like, no, like, this is what we're focusing on. This is where our conviction is. This is why. Be open to change, of course, and pivoting as your product evolves and as the market evolves. But we want to know that you've done that hard work to figure out the product market fit. Technology and IP. So they'll want to know if you have any patents or trademarks filed. I should say trademarks, not trade markets. And then also industry secrets and know-how as well. So often cases, as you all are aware, there are certain things that you don't want to patent because your competitors can re-engineer it in a different way. So industry secrets and market know-how. What is your moat as well? So like, how differentiated is your IP compared to your competitors, and why? We want to know that, like, if there are 10 other different companies like you in the space, why are you different, and why are you going to remain different in the future as well? So you may be differentiated today, but how do you retain that differentiation in the future going forward? business model and traction. So again, this sort of goes back to scalability and growth. Go-to-market strategy, have that inside and out. Pipeline of customers and projects. So we also want to know who are your current customers today, who are the customers that you're working on, what customers you think you'll be able to secure in the future from like a project perspective. And it's okay if you don't have any customers today, if you're pre-revenue, if you're still trying to like sort through that. But we want to know that you've done the work to identify your customer base, know which ones are the low-hanging fruit that which you can target first and like are the easiest ones to acquire from a customer acquisition cost perspective. And then who are your customers that might be a little bit more of a reach, and what's your plan to go after them. And again, yeah, what is your annual recurring revenue, monthly recurring revenue, and then customer acquisition cost. This might be something that's difficult for you, like to suss out right now, especially being like a seed stage company. It's okay if you don't have that metric, but it's something to start to think about putting together and to track in the future as you're getting more customers and expanding your business. Climate and environment, we are in the climate tech space. And if you're pitching to a traditional or a climate tech or an impact focused fund, they're going to want to know why your technology is different and like what impact on the climate are you having, both from a business as usual perspective, like let's say you're a renewable energy company compared to oil and gas, but then also with respect to your peers. And this is something where I think people founders don't always speak to, is why their technology is better for the environment, if it is, than your competitors, both from a financial perspective, from a solution that it's providing, but then also from a climate and environmental perspective. So whether that's water uses, whether that's air quality, whatever problem you're solving for, creating a metric that you can track around that and you can show how you're better than your competition is key. LCA lifecycle assessment, probably haven't done that if you're at the seed stage. That's something that can be costly and just takes a lot of time. That's okay. But as you scale, especially as you're raising a Series A, definitely a Series B round, and investors are going to want to know what's your LCA, specifically having had like a third party done an independent review of your technology compared to the current state of the market. Whereas if you're earlier on, you can get away with doing that in-house. As you get later on the fundraising stage, they're going to want to see that from a third party. Competition and differentiation, this sort of goes back to technology and IP again. Who are your main competitors and how are you different? And then really, how do you maintain that competitive edge? Because you might be competitive today, but we want to know we're not just investing for an exit in the next 2 years. We're investing for the long term, especially at a seed stage company. So they want to know how you plan to iterate on your technology to bring out Gen 2, Gen 3, Gen X to stay ahead of the market. And then team and expertise. I really can't stress this enough, especially at the seed stage, pre-seed, even earlier Series A companies. The team and your background and your experience is a huge part of why we're investing. And we're putting our confidence and faith in you, both from your technology know-how, but also technological know-how, but also in your ability to scale that company and the people you surround yourself with. So I always, it's great it's fantastic when you come across with a founder who is like top notch, knows the industry inside and out. They're sort of your golden person in that they are like an A-list founder, but it's almost more important to surround yourself with the people that can help you scale the company. So it's great if you're that person. But if you're not, like I would take a founder that's say 75% within the pool as opposed to like 100% top tier founder, a 75% founder who has surrounded themselves with the right people, who know the industry, who know how to scale up their product, who have done this before. The team that you build around yourself is key and something that an investor will really look at, especially at the early stage. And then funding and use of proceeds. So we'll want to know, like, I mean, this is pretty standard, your round size, the capital that you've already raised, what your valuation is. But then how do you plan to use the fund? So that's what we want to understand. What's going to go to R&D, what's going to go to customer development, what's going to go to manufacturing if you're at that stage. And then how long of a runway will this give you? So going back to 12-month runway is okay, but honestly, right now, if you're fundraising right now in this environment, not the worst, but it's better to not have to go out for capital again before your next round. So it's more important, I would say, to raise a slightly larger seed that'll carry you for 18 months than raise a seed round and then have to go back out in 8 months for a bridge to get you to Series A because you weren't able to raise the Series A quick enough. Like what we've seen is that it's been taking companies and founders longer to raise their rounds recently, especially last year, but even still this year. And so give yourself that extra time. Like, don't think you're going to be able to raise a seed in 3 months because it's just not going to happen. Give yourself that extra time, give yourself that extra runway, and investors will see that as, you know, a good strategic play in the space. And then lastly, exit strategy and return. So even though you're at the seed stage, I encountered this the other day, a company that's raising a note in a Series A to build up their pilot scale facility. They didn't have an exit strategy, or the founder said, like, I haven't really thought about that because we're focusing just on getting the first project built, which is exactly what your focus should be. Like, it should be on getting to market, getting to the commercial scale, acquiring those customers. But you also need to have that vision for the future. It's okay if it's not perfect, but understanding what your exit strategies could be, whether you would target an IPO or an acquisition, and who could be those acquiring players, and what some other exits have looked like in your space. Just having done that legwork shows an investor that you're thinking about it, and it gives them confidence that you're not just thinking short term, but like you have a long-term mindset, which is key. And then again, just standard, like what the IRR could be for a certain investment, what your EBITDA and revenue projections are, and then what are your margins as well, and how do you plan to get those down, both from like an efficiency perspective and from reducing your customer acquisition costs. So that was a lot.